Seconds. Can you go ahead and verify if it's there live there?
Yes, Mr. Singh, we're live.
Oh, okay. So a brief introduction. A happy Sunday morning to everyone, and thank you those who have tuned in for and have been with us for past 4 weeks, 5 weeks. Um, this is a boot camp, and we started with a brief overview of financial statements. We looked at time value, loan math, all fundamentals of Fin 1, and then bit of Fin 2. We looked at capital structure, we looked at valuation, then we looked at relative valuation. We tried to look at the risk management part. We looked at derivatives and how we can use derivatives to reduce risk. Um, in the penultimate class, we looked at once a risk is managed, how we can use all these towards writing a risk memo or a credit memo. And credit is a risky decision, and how can an analyst starting at her or his career, his or their career, can use this to generate a professional memo used in organizations to take a decision. And what we saw yesterday was how to be math heavy, so that we know we what scenarios we are handling. We looked at a bit of stress testing. We looked at stress testing the revenue. If the revenue falls by 20%, we also looked at stress testing the margins. If the revenue falls and the margin falls, what would be the impact? What we did not look at, and what where this would become a bit advanced, is Monte Carlo simulation. A Monte Carlo simulation introduces a bit of randomness into or volatility into the revenues of a company. Usually, companies working in a stable environment, a large company, would have such risk reduction methods so that the Monte Carlo volatility will be minimized. But if that isn't minimized, then that is something that can also be added to a stress testing or a scenario planning. Finally, we also saw that scenario planning is useful for a long term picture. And we do scenario planning and strategic planning when we know that a company's future for next 4 5 years is secure, and we know what the market is going to throw us, right? The world, again, now coming putting on the strategy hat, we know that the world is VUCA. Now it is Bani. So with so much, if we go to the VUCA, the older framework, the volatility and uncertainty and complexity around in the world, we do not have a 100% sure picture of what the scenario would look like. So what we are going today is to do a simulation of an environment where a client needs infusion of capital in some form. We'll look at the case of what form they are looking at. On your screen is Mr. Prashant, who would introduce himself, and I would be playing the role of credit committee. I have another colleague with me, another classmate with me, and who would also be playing the role of credit committee if they have any questions or any doubts on the math behind it, or if they have any clarification questions. At the end of today's session, what we would like to know is if we should approve or reject based on the recommendations given by Mr. Prashant. And we would also close this. So Mr. Prashant has around 40 minutes to present his slides and his work, and to take us through the company's journey, what company is, what company works on, and other structures and current their plans. Then we will have around 5 or 10 minutes of Q&A, and then we'll close it up. With that, I hand it over to Prashant. Good morning.
Uh, Good morning to everyone who's watching this. So, as Mr. Singh particular session right here is the culmination of all the past sessions that I've taken under him. And so today I'll be presenting this simulation. Right? So I'll walk you through what the simulation is in a moment. But this is a credit memo that I'm presenting to the committee. And here I'll be sharing whether or not we should be leasing to this particular entity. And today I've chosen Maruti Suzuki Limited. So with your permission, I can walk you through the context
Sure, you may
and
proceed.
the example.
Please.
Sure. So can you see my Google screen? I mean, can you see my Edge browser? Or is it still stuck at PowerPoint?
It's stuck at PowerPoint.
Okay, I'll press it. Yes. So I went to Google News, right? And I was just trying to spam the word expand and see which news pops up. And so this one particular piece of news caught my eye. So Maruti Suzuki, and this is dated 24th March, by the way, which is very recent. So Maruti Suzuki actually plans to expand their Gujarat plant with rupees 10,000 crore worth of upgrades, so that they want to expand their production because they're basically eyeing at growth in the passenger vehicle segment, right? And so this plant expansion is the context, and based on this, I had asked LLMs to form a mock question, which I've attached to the mock.
Yeah.
Yes. So the phase one of the Gujarat plant is up for expansion. And like I said, the amount comes up to around 10,000 crores. And this is going to add 2.5 lakh additional units of additional capacity. And they're eyeing at completion at around 2029. So they've come to us, which is the leasing entity, and they've come to us to finance their robotic body assembly and welding equipment, basically. And this is going to be done on a finance lease basis. So this is the answer, right? So the amount of these assets that I mentioned before comes up to around 40 crore, and the tenure that they have asked for is 48 months, and the residual value at the end of the tenure is going to be purchased at 4 crore. And my company told me, hey, I want you to they have an IRR target, work with an IRR target of 13.5%, and take up 0.5% of the whole deal value, which is 20 lakhs at upfront, and then after which your payments will start flowing. So this is what the company has asked, whatever is the right, and whatever the client has asked is the right. So before I walk you through the credit memo, I'll very quickly walk you through the balance sheet, and let's understand the nature of the business, and let's also understand the how the balance sheet as of 2025 looks like. Yes. So as we can see, the very first thing that caught my eye with respect to the balance sheet is that
I think
there,
you have stopped sharing and your only face is in the center of the screen. Your screen share has
yes,
stopped.
are you seeing it now? Is it visible?
I think it's. I don't see anything. I think it's coming it up. Yeah, now it is coming it up.
Perfect, perfect. So the first thing that we see in A46 is that their borrowings are nil.
Can you
Last
zoom it
year,
a bit larger? Sorry for interrupting. Can you zoom it a bit up so that all of us can? Yeah, thank you.
sure. So the units are in million INR, and so as of March 2024, their borrowing stood at 331 million, but this year it's close to zero. It's literally zero basically. And even in non-current liabilities, they only have lease liabilities. Otherwise, there is no debt as such. So consequently, the debt to equity is less than 0.1%. It's 0.08%. That's there. And they also have huge cash in investments. So as we can see here, their investments stand at 55 million INR, sorry, 55,000 million INR, and the same goes for their cash also. Cash is 780 million INR.
So,
The receivables is also,
can we just focus on this part before you go ahead, if that is okay with you? So, are you saying that they have 55 billion, 55,000 million is 55 billion? They have
yeah,
55 billion rupees. So half a billion dollar. 55 billion is what? 100 billion, 100 billion, 100 rupees is $1, for example. Then half a billion dollar is, are you saying, is something what their current cash or investment is? 55 billion rupees is 0.55 billion dollars, right?
55 billion, yeah,
Rupees
half,
is
yeah,
assuming 100 rupees as exchange rate for the ease of mathematics. Then you
yeah.
have half a billion dollar currently lying in as investment. Can you scroll down a little bit, please? Just a little bit. Yeah, please stop there. We see a big drop in cash and cash equivalent from 4,500 to 780, and we see a big jump in investment. So I hope the left one, the D column, is the recent one, and E
Yes,
column is the
yes.
older one. So I'm very curious because I don't have a background. I'm just part of a credit committee member, and this is the company you have brought in. I know, but I've seen a lot of Maruti cars on Indian roads. Any reason why they will not have such they have such low cash and they are willing to put money into investment? Do you think it's prudent, and do you think it will be a working capital problem later on? And finally, have you analyzed the investments? Like, have they put it into 10-year T bonds which are not redeemable, or FDs which cannot be broken, or have they put it like the liquid money which can quickly pull in? Number one. Number two, yeah, their trade receivables have gone up a bit. If you see from 46 to 65,
Yes.
it's 20. It's like 50% hike, jump. That means, are they giving out cars to distributors and cars are not selling in India? Can you paint a picture on the macroeconomic scenario of Indian economy and how automobiles are going around? Of course, I guess that's coming up, but these numbers did make me curious. And finally, what is the market share of Maruti Suzuki in India, in terms of the markets that they operate in? If they operate in four-wheeler or compact sedan or SUVs, what is the market segment and what is the distribution across different types of vehicles that they have?
Okay, so do you want me to take the answers in order, or can we start? Can I start from the last question
Please feel
first?
free. A guesstimate is also fine. I don't need a hard number. I need a a round number, so that I want to know why a CFO or a finance guy, even for you and me, we may want to have 2,000 rupees in our pocket, right? We'll not have 20 rupees in our pocket and everything in UPI. If UPI does not work and we go out in the street to buy something, we have to come empty-handed, right? So you
Hmm.
may use a UPI Lite or something which will work in an offline environment, right? Or at least have 100 rupees on you, bare minimum. If you are presenting to me a company that has had 4,500 units of something, and they let go it and put that money in investment, so is 780 good enough in terms of working capital? So I don't know.
Right. So, if we look at the passenger vehicle segment in India, right, Maruti Suzuki holds around 42% market share. And in one of the earlier slides, I mentioned that they had sold around, I think it's around 2.2 or 2.23. We'll get to the exact numbers once we look at the slide. So it's around 2.2 million units sold just in financial year 25 alone. And portion of SUVs is around 54% of the total industry sales. And one thing of concern here is that Maruti Suzuki's SUV sales is only 28% of its own mix. So that's there. And in fact, that is exactly where Maruti Suzuki is also trying to expand, because if we look at both the spy forces, then the competitive rivalry is something that has to be taken care of. You have to put in entry barriers wherever possible just to secure your competitive foothold. So that 28% of its own portfolio thing is definitely very concerning. So that is one thing. And secondly, you wanted to know where the cash is going. Unfortunately, I did not. I regret not doing a deep dive on that. I currently have no idea as to where exactly the money went.
You may
And
open an annual report in PDF and check. It's perfectly fine. We are all here to approve or reject this thing. It's a working committee. So please feel free to minimize, open a browser, open a PDF, do a Control F. We are all trying to make use of all our time, our time, and approve this. If Maruti is run by one of the most experienced management, so they would know what they are doing. But that's a big jump. I'm sure you would also appreciate. So it's natural to be curious.
sure.
Similarly, another big
Yeah.
another big jump. Sorry, if I may, another big jump. If you just see math and you don't know anything about anything else, you will see a 43 becoming a 3600 in line number 25. So I am very curious. I am a statistics guy. I look at mean, median, mode. Any high variance scares me. I have worked in blue chip companies and I want very low variance. So if a young boy comes to me and say, Naval, I am a 60%, on an average my class 10th and 12th and graduation score is 60% and my standard deviation is 5%, that means that person would have scored 75 as well and 45 as well. That is mu plus 3 sigma, mu minus 3 sigma. That's what 6 sigma is, right? 75 is good, but 45 is really scary, right? Rather, someone comes and says that I have got 60% throughout my career, but my standard deviation is 1%. That means the student has scored 57 to 63. That is a more stable performance. So that's what I'm coming from. I'm coming only from statistics angle here. These big variance scare me. I'm a very conservative person when I'm going to put in my money and approve any credit investment decision on the company's behalf. I hope you would also appreciate it, as both of us are part of the same company. But
Certainly, sir.
what if you can do a little bit of digging to know why these sudden changes happened, and has Maruti been doing this kind of high variance in other bank balances, cash equivalents? Is it very common? You may ask this to ChatGPT as well, because that's perfectly fine. We are not trying to become a tech expert. We're trying to solve the problem.
Yeah, that is also currently underway, and I'm also taking a very quick look at the notes of financial statement to see if there's any further context. scared by getting stuck. So if you could kindly give me 2 more minutes, I'll
Please
talk
feel
to
free
the
to take your
structure
time.
manager.
You have full 40
Sure.
minutes for you. So you have time till 10:20.
Noted, Mr. Singh. Um,
Yeah.
uh, so, is it imperative that I answer this question right away, or can we move to the next question and just
Please
take
feel
this
free.
question?
Please feel free. Just I want to raise my concern as a credit committee member that, and
Certainly.
of course, this is a recorded meeting, so the minutes of meeting will be given to all the committee members who are not present as well, so that they can also take an opinion. We respect your analysis, but as a company, we will do a second level of analysis before we make our investment decision. So, but we are very eager to hear about your recommendations. And if you haven't done this level of analysis, it's no problem. You can revise this and come again. But let's finish through the first version of the draft that you have published, and then we can look at those questions later as well. Just one more question before we go ahead. Um, when you look at the inventories have gone up, and I could also see a big amount of money in trade receivables being put in. So, i- when you do in the future second round of analysis before you put it into final approval of money being given to Maruti, would you be kind enough to also look into the fact that is Maruti Suzuki trying to stack or stock the channel, what is called as channel stuffing? So when they're not able to sell stuff, they just and they do not want to stop the factory because the workers will be idle and the workers will start protesting. So what they do is that they do not furlough workers, they do not lay off people. They just keep making cars and then look if they can export. If export is also not possible, they dump it across the different dealerships across India, whichever country that they operate in. This practice is known as channel stuffing, and it increases the account payable because dealers do not pay upfront unless the car is sold. Dealers, and this, if you can also look it up, if they have changed their dealer policy and vendor financing and supply chain financing, that uh, did earlier dealers purchase the car and then realize the payment from final customer, or dealers always keep the car in their premises, in their dealership and showroom, while the cars they borrow the car from OEMs and they do not pay any money, and they just insure the assets in the showroom, and once folks like you and me go and buy the car, then the dealers take our money and then they give it to the OEMs. Like what the structure, and has Maruti changed it or done some innovation there? Because we may find something very unique that other companies who are their rivals may want to replicate from the finance structure. So a Mahindra or a Tata can replicate. I was watching IPL yesterday, the match, and I could see a lot of Harrier ads there. Finally, before we look at other scenarios as well, I could see the requirement for robotics in manufacturing, which is a very welcome move. Um, we would have to look at two more angles. One is, are they making an ICE vehicles or EV vehicles? Because in IPL, I was watching ads of EV vehicles, and the current market scenario would force a lot of government policies to move towards EV, which are less import dependent and more environment friendly. Second is, apart from this being EV or not EV, when they look at modernizing their robotics arms, or taking in money when there is zero debt. They have enough cash into their portfolio. They could have, it's like having 100 crore in my bank account and taking a loan of 1 lakh rupees. Doesn't make sense. You will say Nawal has 100 crores, why can he take buy an iPhone from there? Why is taking 1 lakh rupees loan? So what is the intention behind taking loan when they have so much money into their cash reserve? Um, if you can just put some light on that as you move ahead, that will be very kind of you.
Sure. So, given that their loans are very low and they're relying entirely on lease payments, also as we would see further in the discussion about their debt service coverage ratio and a couple of other metrics, one thing is very clear, right? Uh, so on paper, this company might look like it doesn't really need loans. I mean, their debt equity ratio is less than even 0.1%. So, given that that is the case, if they are slowly catching up to other competitors, if they are ensuring a competitive growth, what usually happens is there's a huge capital expenditure requirement, and they might need their money to go invest in the right places so they can allocate resources towards competitive. Strengthening the competitive foothold basically. So things like machinery, plant, equipment, office infrastructure, it definitely makes sense for them to lease, given that it makes sense financially from an NPV and other metrics, and other standpoint and standpoint of other metrics like these. So that is there. Also, Mr. Singh, to take up your question on channel stuffing, right? Currently, my LLMs are passing for any news that explicitly mention channels. Channel stuffing. But from a financial point of view, also, I think channel stuffing might look like this. So if their revenues are not increasing on par with their receivables, then that might be a faint hint that they are dumping their stock onto the distributors or their dealers for a future receivable while their revenue is not increasing. So that might be one thing. And if their revenue is not increasing, but their unit is increasing due to their credit
Yeah,
terms, then
because sorry for interrupting. Because as we can see in line number 20 and line number 23, their trade receivables have also risen. Their inventories have also risen. That means they are making stuff that nobody is buying. Why will you make stuff that nobody buys? You have to stop making stuff, right? Are you not agile enough to retool it? For example, if India doesn't like sedan because the roads are not good, India is becoming a SUV market. I had a Honda City and I had a Nissan Sunny before, and I love those cars. But those sedans will always scrape the road and the bumpers and the stuff. So India is becoming an SUV market. So is that moving towards that part, and are they doing something that people are not buying? That's a very serious thing for us to imagine if we are funding someone who's making something that nobody likes.
sure. So when we look at last year's receivables and this year's receivables, there definitely seems to be a concern regarding channel stuffing. But I'm also side by side passing and seeing if I can fetch any information on the 5-year trend in receivables, right? What's the 5-year trend in revenue? Maybe that could paint a little more robust picture of channel stuffing is what I think. But let's see what the results show. Um, Meanwhile, do you have any observations that you might want to put at me, Mr. Singh? Any questions that you'd
No,
like to test me on?
no.
I
I
mean,
guess I guess they are invested into property, plant, and equipment, so that has gone up. If you can you scroll up, please.
sure.
Yeah, so you would see a big jump
Let
in
me
property,
note that.
plant, and equipment. It's gone up by around 60 units. So that 60 units becomes 33%, I guess. 60 by 180 is one third. So 33% jump in PPE, which shows that they're investing. It's a capital intensive business, and we would love to know if the 30% increase in property, plant, and equipment, and does that what kind of revenue percentage growth it implies. It's very popularly attributed to Narayan Murthy. He said that to start an IT company, you just need a desk, a telephone line, and a computer. And that's exactly what he started with in 1970s and 80s. He said, I just needed a table to sit, a table and a chair, and a telephone line, because those days the telephone line you connect and you have a dial-up modem, and then a computer to work in. So then if you increase asset, you increase money. You increase consultant, you increase headcount, you increase money. It's a linear multiple. But here, if the PPE has gone up by 30%, and it's a huge number, if the revenue hasn't gone up by 30% or whatever X number, I don't know what market or what the segment number looks like, then I would be very curious if the fixed asset efficiency is good or not. Are they utilizing the fixed asset or not? Are the plants being utilized or not? Or are they investing in assets which they will be using in future? Or do they see a demand in which they are investing assets? I hope you understand where I'm coming from and my line of questioning. Because if you're making something and you're stocking it, you're not selling it, and you're now investing more into plant, if you are, suppose you are making petrol vehicles and they are not selling and you're investing into plant to make EV vehicles, that's absolutely reasonable. I love it. Everyone loves it. But if you're trying to invest to make more ICE vehicles and suddenly the central policy changes, and automobile sector is a very, very policy driven structure. So unless you influence government policy or you are aware of government policy, suppose government has hundreds of thousands of boleros given to all the collectors and DMs and SPs, and this is public knowledge, right? And government says you want to scrap everything. Like Delhi government says you want to scrap 10-year-old cars. So government is trying to bring in something, and government will not buy EV, for example. So then they can anticipate a demand, and they will know that the cycle has come in and a lot of vehicles will be purchased, and then they've invested. It's perfectly fine. I know in the real world you will have a technical expert, a subject matter expert, and a domain expert working with you along with an analyst and a simulation expert, and you are working alone. So you can use the facilities of a large language model to understand and get those insights. But it's very critical for us to know before we approve any investment into a client or into a prospect, uh, if that asset investment is aligned towards market, and market is behaving as per the current macroeconomic scenarios, and where this money is going into. I understand that you may say that it's just an equipment and it's in a small plant in Maruti. Why do you need that kind of due diligence? Because the due diligence doesn't care about the amount of investment, it looks into the market and the client in total. So that's the reason that the depth of questioning is warranted, right? So that's my disclaimer. But still, would love to know if you can in future, why 30% rise in just 1 year into plant and equipment. That's a huge rise, and they have booked it into their report. That means the plant is ready. Unless the plant is commissioned, they would put it as work in progress. If you see the capital work in progress, it's not there. That means they have inaugurated a plant. Once they inaugurate, then only things move from line number 8 to line number 6 after inauguration. That means it's a working asset. Yeah, you may proceed.
Certainly, Mr. Singh. So, in fact, I'm very glad you brought this up because given that we are leasing equipment that will go on the assembly line, even if a company that is very robust as Maruti Suzuki, their loans are close to zero and everything. So even if there is no credit risk, we will of course see it in the presentation. But assuming even if there is no credit risk, there is always asset risk, right? Like you exactly pointed out, there is the risk of obsolescence and there is the risk of regulations catching up. So if the, I mean, if the plant is sitting idle, then they should definitely be in a position to still repay. The assembly line is not being utilized properly. They still have to repay their lease payments, and of course, so the exact stress testing we'll definitely see in the future. But yeah, asset risk is definitely something, and given the whole fiasco that is going on in the Middle East right now and how it has bearings on the demands of EV skyrocketing in both four-wheeler passenger vehicles and two-wheeler passenger vehicles, that is definitely a concern. Yes.
Yes, please. You may
my
proceed.
large language model, I'm sorry.
I said you may proceed. Yeah, please.
So my LLM is saying that the majority of the investments in PPE is going towards the plant in Gujarat, and unfortunately, it looks like the insight that it can gather is a fairly generic. But what I do have in front of me, which I'll be presenting, is the exact breakup of PPE as given in the annual report. So what I've highlighted in yellow, as we can see, is that so there are three index that is given. So they have their balance that's on 2023, 2024 year, and we have 2025. So in between 2023 and 2024, the number of buildings that have acquired is 2 billion, and now it's 24 billion. So as we can see, this 24,000 million, which is 24 billion, is over the addition. Looking at also in plant and machinery, there's an addition of 62 billion, right? This is very consistent with their expansion goals, but I'm not very sure which plant it is going towards. Unfortunately, LLM is also not able to find me the exact recipient, the exact plant that all the investments are going towards. But there's a very decent reason to assume that it is going towards a plant in Gujarat because it has one of the highest capacities actually.
Okay.
Can I move further, Mr. Singh? Are we good to go?
Yeah, yeah. Please, please.
Sure. So with your permission, I will currently shift towards the ratios and then towards aggregate.
Sure.
Yeah. So one more thing before I'm sorry, but before we move on to the ratios, one more thing that caught my eye is that their revenue from operations is 1,519 billion, but their other income is also around 47 billion. So the PAT and everything that is calculated based
I
on
think
the
the
total income.
sorry for interrupting. I think the screen is stuck at the PDF.
Oh, I'm so sorry. I'll switch it. I hope it is visible now.
Yeah, it's visible. Excel sheet is visible.
Okay, perfect. So I was saying that the revenue from operations last year was 1,519 billion rupees, but their other income is also around 47 billion. So I wanted to adjust for the effects of the 47 billion. So wherever there is EBITDA and EBIT, I have only taken adjusted EBIT and adjusted EBITDA, where I've basically just subtracted this little figure from the total income basically. So that's something I've done. And after doing that, we observe that the EBIT margin, the EBITDA margin is around 12%, EBIT margin is 10%, and PAT margin is 9%. So it is all fairly close together. And another very interesting observation is that their interest coverage ratio is 75x, and their debt service coverage ratio is around 83x. So, I mean, we have good enough reasons to assume that their lack of loans is maybe inflating their debt service coverage ratio to an extent that to an extent that it appears extremely inflated, but going by the ratios, going by what the math says, it is 83x. And to calculate the EV to EBITDA ratio, I have to take all of these, their market cap, their debt cash, investments, their
Can you
share
zoom
price.
this up a bit? A bit.
Sure.
Thank you.
So, so the debt service coverage ratio is around 83x, and their EV/EBITDA is around 16.28. So this assumptions in mind, I'm going to shift to the credit memo for this company that we've
It's
looked
an
at.
asset heavy company, no? So EBITDA and EBIT will be very much different, no? Because they will be doing a lot of depreciation and amortization. All asset heavy company we should look at EBIT or EBITDA.
Sorry, are you asking me that? Are you asking me to replace EBITDA by EBIT to adjust for the effects of depreciation?
Uh, what I'm saying is we can take a look at that number as well, just to know how much is the impact.
Sure, sure. Okay, let me just calculate it.
It's 20x.
It is even higher. It comes up close to 19.5. Just a second.
Fairly valued company, and I hope in the future you have also, because that's a ratio slide. Have you captured PGA somewhere?
I had a bit of an issue trying to calculate PEG, but I asked my LLM to do it, and the PEG is around 0.82x.
It's very low.
I have taken the PATS
You
CAGR.
can you can so a good, sorry for interrupting, a good representation. So what is PEG ratio? You can price of an equity stock. So for that you can take the book value or market value, your choice, and you can make a mention there. And earnings you have here, by you have the EBIT here. Very critical is the growth. So growth in the, what's the growth in the free cash flow? That is the growth ratio or growth in revenue or whichever growth you're looking at. Um, if it is less than 1 PEG, then it is a very undervalued company. And if it's a debt-free company and undervalued company, is it because they are so conservative in their cash management process or financial management process? Or usually a debt-free company is a risk-free company. It should be traded at very high PEG ratio. What could be the reason that the PEG is so low? Why is market not liking it? So why I'm asking you is that market doesn't like, as you look it up, market doesn't like, suppose a company called XYZ. What is P? P is the what you and I and Ankit thinks about a particular stock. It's that's where
Okay.
your expertise, psychology comes into picture, behavioral finance and behavioral economics come into picture. We feel that Infosys should be worth 3,000 rupees a stock. Its equity, its book value might be 100 rupees. So it's 30 times the book value it's trading, right? It's because our what used to be called as animal spirits, that we feel that is much more precious. And when is the P high? When the P part, capital P, when the debt is low, because debt is serviced first. So if the company goes bankrupt, they will first, for whatever money that they have, they'll pay the debt first. Whatever money is left from that, they will pay our, we will be able to sell our stock or get some money, the book value of our stock. All three of us, equity has zero returns, and even the subsidiary debt has also lower returns. So markets don't like companies which have huge debt unless they're generating very high returns and they're using debt for the interest tax shields, and a lot of complexity goes into the picture. If it's a debt-free company, like then it's same as Infosys. Infosys has zero debt, and Narayan Murthy is a very conservative company, and I'm an ex-Infosys, so I know that Infosys is a very conservative company. They have, at my time they had 30,000 crore or $5 billion. Dollar was 60 rupees those days. 2015 I joined Infosys from campus. Dollar was 60 rupees and Infosys has $5 billion of fixed deposit on which they got interest, just like an old person in our family or like all of us have FD in bank. They had the same FD and they paid interest, and everyone didn't like it. They said, why are you making FD? Because they are the most, they wanted secure, low paying, guaranteed return investment decision, rather than investing in any kind of fancy or volatile way, right? So this is exactly like Infosys. So if Infosys is trading, if PEG of Infosys, or I know automobile sector works differently, IT sector works differently, but if you look at only from the finance eyes, and if you only look at it from an investor eyes, from a retail equity investor eyes, then a PEG of an Infosys and a PEG of Maruti Suzuki could be a little bit comparable, with some exceptions being made. So a low PEG doesn't make me understand why is market not liking a debt-free company like Maruti Suzuki.
So the sector PEG, I think, is just firstly, I'm sorry for not being able to give a very clear answer. But there's this one thing that's not making sense to me, which is that their earnings growth has been fairly strong, and in fact, I think the trend of their PAT has been growing in some double digits in the recent years, and their price to earnings multiple is not very high. But given that that is the case, I'm able to understand why the PEG is less than one.
That's where in real world you will have an automobile expert, for example, or if an oil and gas expert or a banking expert or a healthcare expert supporting you, or jumping into you, you will be presenting in a team, and maybe it's that the car models are not flashy enough, not lucrative enough, the positioning of their cars is not good enough. We don't know, because market looks at humans. Market is what humans like you and me. If, and that's another question that you can make a note of, that if equities of Maruti are traded in the market, what percentage of the equity is owned by retail investors? If 90% of the equity is owned by capitals like JP Morgan and is using them, is a channel for large banks to invest into the equities of Maruti Suzuki, and retail investors are only 5 to 10%, then our voice doesn't matter, right? If retail investors are 99% of the equity holders, then it's like all of us don't feel that the car models are pretty enough, nice enough, use good enough, so we'll rather buy a Toyota or a Suzuki or a Honda or whatever, but will not buy a Maruti car. Even if they may make and sell cars, but the cars are not thrilling enough. So now you are wearing the hat of a car enthusiast, and you are sitting in Chennai. Chennai is known as Detroit,
The Detroit of India.
the Detroit of India. Detroit is the car manufacturing hub. So you have Chakan in Pune, you have Gurgaon, you have Chennai, and you have Sanand in Gujarat, which are the hubs of automobile manufacturing in India, right? So these things can come to your rescue and can answer why low PG.
Yes. And by any chance, is it also tied to the transition that the company will have to make during, I mean, going from sedan to SUVs, going from ICE to
Could be,
EVs?
could very well be. I worked at Indian Oil Corporation before, and I know that when government mandated a jump from BS3 to BS4 compliant fuel, it was a big capital investment to be made by all the refineries of BPCL, HPCL, IOCL, to make BS4 norm. And then suddenly government, not suddenly, after half a decade, government said that no, BS4 fuel is not good enough. We need to have zero lead and low carbon, so we need BS6 petrol. So then the refineries of Indian Oil had to be retrofitted with new equipment, and some processes had to be modernized to make BS6 petrol. If tomorrow government says we want BS7 petrol, Indian Oil has to make huge billions of dollars of capital investment in the refineries, right? So it's a capital intensive driven by policy changes. In the same way, When government says that we want the engines to be able to handle, for example, a lot of people currently are now putting biofuel. They are putting ethanol blended petrol into their engines. And a lot of companies are currently saying that the car engines are not designed to have ethanol inside their tanks. And that's harming the life of cars. So now, if you become the CEO of, I wish and pray and hope that you become the CEO of Maruti Suzuki India. But if you are today, then you have a very tough decision to make, that do you work on the internal combustion engine to handle an ethanol, do you stop making diesel engines, or do you move towards zero engines, towards a motor generator set and towards an electric vehicle, you know. So while this might just be a small portion of your credit pricing memo and deal risk memo, in the larger picture of a strategic turnaround of Maruti, this could become a very good value addition for you. This exercise of behaving or working like a CEO and then taking a call and then putting capital where the mouth is, you know. And then, of course, you were mentioning couple of management consulting models. You can then look at cash cows and the growth share matrix of BCG, who is growing fast, and then you have dogs and you have stars and all those. That's a one popularly used model in industry. So, but then you would know that should I invest into making ethanol friendly engines? Should I make diesel engines? Not make diesel engines, because diesel anyway is not selling in Delhi and other areas with because of 10-year ban, post 10-year ban, or we should completely move. Those things would also come into picture. Yeah.
Thank you so much for the insights, Mr. Singh. In fact, I'm sorry to throw the question back to you when I'm the person who should be taking take the questions. But yeah, thank you so much for the insights. So can we move to the credit memo?
Yes, if you want to do the stress testing, I can see stress testing tab. In the interest of time, we have NPV. We are over by around 5 minutes. I hope it's okay with Ankit to stay for maybe couple of more minutes, 10 minutes, if that is okay, Ankit. Or it's fine with him. Okay, perfectly fine. Then 10-15 minutes. Yeah.
Okay. So I'll quickly press the slide and then I'll walk you through the execution.
Sure, please feel free. Over to you.
So can you see the presentation, Mr. Singh? Can I get a quick clarification, please?
No, I can just see your face. Maybe it's coming up. There's a lag, but I can't see it right now. It's still not there.
Yes, I'm resharing. I hope it's visible this time around.
Yeah, now something is coming up. Now it has come up.
Perfect, Mr. Singh. Thank you so much. So the credit memo of Maruti Suzuki.
Now it has gone away. I think the moment you're putting it on full screen, it goes away.
Yes. I'll put it on a small screen instead. Uh, yeah, is it visible now?
Yeah, it's visible.
So in the interest of time, I'll just zoom in on the
Sure, no
working
problem. No problem.
the workspace itself instead of presenting it. So yeah, the business overview of Maruti is that, like I told you, they have around 2% market share in the passenger vehicle segment, and most important, sorry, 2%, and most importantly, 85% of what they manufacture is sold domestically. And Maruti has a reputation for being the car brand for value for money cars over a long period of time in India. So, given their strong presence in hatchback sedans and slowly in SUVs as well, so we noticed that their XYZ Capital. So their intention is to add 2.5 lakhs additional units to their existing output, and case has to be done by 2029. So the financial risk aspect, when we look at it, what we realize is that the ratios. Let's look at the ratios first, then come back to financial risk. So the debt equity is 0.0. It's close to 0.01%. In fact, that's how low it is. And their interest coverage ratio, their operational EBIT is doing the heavy lifting, and the fact that there's no debt, that is also contributing hugely to the fact that there is no interest risk. And EBITDA, we just looked at it. In fact, with the recommendation of Mr. Singh, we also looked at EV by EBIT, and it turned out to be a little more higher, towards 19.55x instead. Whereas the sector norm, sector average for EV EBITDA is around 8 to 12, is what screen is. And so when coming to financial risk, the shift to premium SUVs will definitely demand some sort of reallocation of resources, some slight dip in revenues, and some slight dip in the volume sales as well. And given that we're not entirely clear about the channel stuffing practices, although there are certain evidences that point towards it, like the sharp increase in receivables, and there are some evidences that point against also, so we are slightly inconclusive on that. But the key insight that we take from financial risk is that the 40 crore lease value which is there for which they've come is only 0.28% of their annual revenue. It's not even 1%. So that is definitely a marker of confidence that we have with us. So their funding ask is 40 crores, and over the tenure of 48 months, and their residual is 4 crores, 10% of the initial lease value, and we are charging a processing fee which is equivalent to 0.5% of the deal, and here it is 20%. The only, given that there is no credit risk, the only risk that we see, I mean, of course, we'll expand on it after the stress testing, but right now there is a huge risk which falls into two domains. One is the construction is getting delayed, and due to which the plant is sitting idle right before installation. We'll have to create a covenant that basically mandates them to pay regardless of the state of readiness of the plant. So that is one thing. And secondly, as we discussed, there's always the risk of obsolescence. A better product might come from East Asia, it could come from North America or wherever. So definitely competition is something that we should look out for, and the effects that it will have on technological obsolescence. So our recommendation, given all of this, is a definite clean approve without any reserve account, because they are well able to pay their lease payments on time, and we can definitely include a kill payment penalty clause of 2 months rental just to protect IRR, because one factor that is also contributing to IRR, which we'll see in a while, is also the residual value which occurs at the end of the lease period. So we vouch for the company to go for a 48-month tenure, and definitely a company such as this is a prime borrower. So I'll very quickly walk you through the Excel sheet as well. So for two NPV calculations, and this for the 48-month tenure, unfortunately we're not able to.
Please zoom them up if you can.
Sure. So what is visible right now? So IRR annually, unfortunately, we're not able to release 13.5%, and we'll definitely see why. If I go to goal C, set sell the value basically asking us to charge an annual rate of 12.96%. And I'm not entirely sure if percentage interest as high as this is floating in the market, given how growing the leasing industry is and how competitive it is going to get. So instead of eyeing at an IRR of 13.5%, keeping the interest rate, annual interest rate at 8%, we notice that the net present value is around 3 crores over a period of 48 months. So, a bit of stress testing. I've taken the base case here and two special cases where Maruti Suzuki is facing a revenue crunch of 10% and 20%. But in all cases, what I've done is, as you can see, I've maintained the EBITDA margin and the EBIT margin as it is. So this is not considering any raw material cost pressure. This is not considering any supply side shocks. So if Mr. Singh and Mr. Gupta, with your permission, if you have any assumptions that you would want me to make, we can also definitely try it out. So, so with the EBITDA and EBIT margins constant under revenue pressure, the debt service is constant here, and as we can see, the ratios are still holding up pretty good, and so is the ICR. So government is not getting pleased anywhere. So the appropriate lesser action I've recommended is just to monitor the situation, because the company is in such a good position, credit-wise speaking. But of course, there is a lot of off-balance sheet risks as well. So, which is what I've written in my final stress testing recommendation in my PPT as well. So with this I conclude my presentation, esteemed committee members. So if you have any questions or if there's anything that you need to discuss, I'll be happy to definitely. Please go for it.
Ankit, do you have any question?
Hello. Yeah. I think I'm audible.
Yes, sir. Yeah.
Thanks for sharing your analysis, Prashant. Very well done. And our really nice observations and questions. Just like basic questions around industry risk. I know you did cover, Prashant. Like, what are the top three risks that you would highlight to the board members, which the industry is probably facing or might face in the coming years? And are there any mitigants that you think Maruti Suzuki has inbuilt in its own organizations, which maybe help counterbalance those risks and makes it a better investment or for us? So that's just like a basic question.
Sure, Mr. Gupta. So the number one risk that we might face is technological obsolescence, and of course, the ability to pay is not definitely constrained by them, but it is something. I mean, it will be a risk, because if XYZ Capital tries to repossess the equipment, it will be hard to sell it to anybody else if it is obsolescent at that point. So that is one thing. And if the second risk that I can think of is if Maruti Suzuki tries to pull out early, then it will definitely affect our NPV and IRR forecasts quite a bit, and it will definitely take a hit depending on how early they're pulling out, because their cash position is also very strong. And the third risk, of course, the lowest in terms of severity as well, is the fact that construction delays might affect plant readiness. But of course, we are going to, the mitigant here is Maruti Suzuki will be obligated to pay their lease rental regardless of plant renews. The only risk for which the mitigants might not be 100% sufficient is the repositioning, the repossession and the obsolescence risk that we'll be facing after the equipment comes back to us.
Okay.
Hey, hi Prashant. Thanks for sharing this. I had made a couple of observations during the session as well. Uh, just final observation or final question here. You have recommended a go ahead for investment into Maruti Suzuki leasing, and they are looking for robotic welding and body assembly automation equipment on a lease basis. I think if this is a new plant and they have capitalized the building and equipment, um, if you can also look at the equipment manufacturer, for example, if they are putting in machinery from Siemens or Honeywell or ABB or whoever who is the original equipment manufacturer, so they and what their customers are, then the obsolescence part gets handled. So this equipment, suppose these robots are coming in from say Sony, or I don't know which robot. Suppose they are made by Elon Musk's company, which makes the robot company. I don't remember its name. And if they have multiple clients in India, then you can sell them to those companies if you repossess them in the worst case. Looks me personally as a good investment, secure investment going in, and rather I'll go back to the PEG story and say that in India the markets are growing really well. All the companies have done good IPOs. So this is like I'll give a reference to my another past employer IBM. A founder of IBM had written a book called Elephants Can Dance because people said that IBM is a very 100-year-old company. It's not agile enough. AWS and Microsoft and Google will come and eat up IBM share, right? So he said that no, why elephants can dance and what they are good at and what IBM knows better. So this is that elephant. You have to convert as a committee member. I would recommend uh, beyond this deal. This deal is anyway going through. Is that try to convert this elephant into a cheetah or a gazelle, because I could see 65,000 million INR, 65,000 million crore or million INR, whatever thing. It's about 6,500 crore rupees worth of assets under the PPE, property, plant, and equipment. So we assume, suppose out of 66,000 crore of PPE, if we assume that 20% or 10% of that is E, which is equipment, that makes 650 crore of equipment. Take around 700 crore worth of equipment across all the plants. So out of 700 crore of equipment, they are borrowing how much from us for this robotic arm?
40 crores, Mr. Singh.
So it's 40 by 700 is 4 by it's
4 by 70.
yeah. So 40 by 700 is around 6%. So 6% of their installed equipment base is what they're looking at. So I would rather suggest that look at the 94%. That if they have 70,000 crore rupees worth of property, plant, and equipment, and suppose 700 crore worth of equipment, why are they not leasing the remaining 660 crores? Why not? Why only 40 crores? You can go and write large leasing deals and convert everything into lease, and they can sell those back to us because they have zero debt. We'll be more than happy to buy it from Maruti and then sell them back to them and give them back on a leasing basis. With that, the utilization will rise up. Our payments will start kicking in immediately. We will possess a lot of assets that we can then work with the vendors and ensure that these assets stay fresh and procure them from vendors at a much discounted price. For example, if they are buying a transformer or a motor or a generator, we can buy 1,000 transformers and then sell them across at a cheaper price, right? Because they would be negotiating only for them. We would be negotiating with, suppose if we reach for the stars, we can actually make your practice as a gold standard for other sales reps so that those who are working with say Hyundai or Mahindra or Honda, they can also do something similar, and then we can have a complete automobile practice of leasing equipment and then procure them at a lower price from OEM and then write them up. Finally, a good suggestion would also be to for our pre-sales teams as well as you to keep a lookout of these plants when they are being procured, when there's a bhumi pujan done. Bhumi pujan is a popular practice when they break coconut and they inaugurate a land and start, because that's the time they're looking for equipment because the plant, the civil construction is happening. That's where they will start buying equipment. If we can be a prime contact to them, if we can reach out to them in advance and offer them the chance to not block their capital and take it from us leased equipment, that will help them reach their project finance closures faster, and that will help them launch new projects with the same money that they have. I hope that's making sense. Rather than missing that opportunity and later on buying them and releasing them, it's better to give them on the first lead. So it will be my suggestion that I could see in newspapers that JSW Motors in launching. Jindal Steel has never been into automobile sector. So if JSW is setting up a plant, I would rather request that you hire some more people in your team and keep a lookout of this on newspaper and property purchases and be proactive enough so that we can land these good deals. That's my observation on what on the presentation, and of course this deal looks very good. Thank you.
Thank you so much for your valuable insights, Mr. Singh and Mr. Gupta. So I will definitely incorporate all these feedbacks, and thank you, Mr. So I'll definitely incorporate all these feedbacks, and instead of just relying on ratios that which happened today, I definitely have a lot of takeaways this time to look at the larger market, both in terms of the exact touch points at which I can make contact during the sales phase. Also to look at where risks might come from, which might not be very apparent when looking at the balance sheet. And even when looking at the balance sheet, to be able to investigate the reasons for changes instead of just pointing out changes like I did today. So definitely, I have this time around. I know what kind of questions to ask, and how those questions can definitely lead on to further investigation, which might give insights for our leasing decision. So thank you so much, and I really can't emphasize on how grateful I am for this session to be taking place.
Thank you,
Thank you so
and
much.
thank you for everyone who has been watching us. We'll close this up with a couple of chat. But for all those joining us online, this was the last session. Usually, this is one of the most popular ones, so we did this role play. I'm very thankful to Prashant and Ankit. I'm stopping the recording right now. Please stay tuned for more such exciting, high tech, high business, high finance content.